Hi there, it's Will Riggall from Clime Investment Management. I'm the Chief Investment Officer. I look across a broad range of assets, but today I'm here to talk about the Australian bank sector. What is normally a rather boring discussion has turned interesting in the last few years as the Australian bank sector has led the ASX in delivering those strong returns. If we look back across a 2-year period, we've seen the Australian market up a very strong 20%. But as we break down the banks, we've seen CBA lead up significantly. Then Westpac has been the next best performer, executing a very strong recovery. And then we've seen National Australia Bank and then the laggard being ANZ. Of course, as we invest, it's about looking forward. So I'm here to talk about what we see in the general banking industry, what we think are the key drivers that we're watching, and also how we're positioned over the next quarter to a year actually to understand where we should be positioned in banks. We've made some quite material changes of late. I guess is at a high level we are underweight the banks. We are conscious of the size of the sector weight of the banks in the ASX. It's around about 25%, so it's something that we have to be conscious of. The extraordinary recovery we've seen since the COVID period is very much about the worst case scenario that was expected not really playing out. So when we think about the key drivers of banks, there are a few that we watch. There's credit growth, loan growth, there's the net interest margin, the margin or the return that they can get from when they lend out their money, and the cost of actually sourcing of the funding source. That changes a lot over the period, but really those net interest margins should be relatively stable. Largely that's changed by competition. Then we've got the underlying controllable operating costs of businesses, and that's what stage they're in. What are they trying to do with their IT infrastructure? And of course, when they're lending out money, they need to make sure that they get repaid. So the loan losses is an assumption that they make, which really does drive a lot of the returns. So what have we seen over the last period? We've seen a strong recovery in the margin they've been able to make from lending. It's returning to more normal types. They're not over-earning, I'm not here to state that, but there's been a breakdown between the stocks. So if we think about CBA as the star of the sector, the best performer, valuation-wise, we're seeing a huge dispersion between them, but really what it can be explained is just the quality of the operational performance of Commonwealth Bank. Their net interest margin has actually expanded over the last year, while the other banks are starting to see those headwinds play through. Broadly, as we stand back, a lower interest rate environment is a headwind for banks, so that is a challenge. But of course, that's offset by the amount of loan losses or the expectations of what. So lower interest rates improve the ability for those borrowers to pay back the money. So again, CBA the leader on that front. But when we look again at how we are positioned, very much we think about those key metrics and look at what are the key drivers, what are the few things that we can see, what's our insight amongst the banks. And so I guess if we look across them, loan growth is broadly similar across them all. And then we go to net interest margin. I talked about net interest margins being somewhat under pressure. That where we look for self-help. What is a bank doing to actually generate or the stability in its own net interest margins? CBA itself has a great funding resource. It has the biggest broker channel, has the biggest self-funding that has enabled it to borrow at such a low cost. They're not going to those global markets. ANZ and Westpac are more challenged. They get around somewhere between 20% or so from their own channels, which is at that lower cost. But NAB, and one of the reasons why we like this stock at this point in time, is that National Australia Bank has actually done a fantastic job of reinvesting in its own business to be able to support that funding of its balance sheet through its own channels. So of all the 4 banks, we're about 50% of CBA's, a little bit lower across the board, but National Australia Bank is starting to move higher. It's actually increased its own sourcing, its own internal funding of its loan book, from around 35% to 40%, and we see that as structural growth. So as this bank, the risk is that all the others are seeing the great interest margins, and its position in the SME sector, it's under a bit of attack there. But as far as self-help and the ability to counteract those headwinds from lower interest rates, we think National Australia Bank is a key reason why we own that one. I guess if we stand back, return on equity, the amount of earnings or the returns they can get per dollar of loan that they lend out, again, CBA the leader, and then we've got NAB as number 2 at around 10%, and then we move down to Westpac and ANZ the lowest. So we don't think the valuation of Westpac and NAB being in line, we think NAB should actually deserve a higher rating, and as we pivot between the banks. They are highly correlated, so there's a lot of value in being different. That's where we're different at the moment. If we talk about our number 2 position, what we actually see within ANZ is a lot of self-help as well. They don't have the quality of the franchise that the other 3 banks do, but what they've done really well over the last few years is de-risk their lending. Shane Elliott, who has just left, handed over to a new CEO, so there is change across the broader sector as well within ANZ. What we're seeing is a bit of self-help. They made the Suncorp acquisition, so there's natural cost out and synergies that they can do to rebuff the CPI plus cost inflation we're seeing across the board, and we think that's deserving of our capital at this point in time. ANZ trading at 20 to 30% cheaper than it's been relative to its own history and relative to the sector in a long time. It's got the highest yield in the sector, and we certainly think it's one worth seeing if this new CEO can make the changes to actually see ANZ return to the pack. That's probably it from me today. It's great to give you these short, sharp updates, and I really hope for you to tune in next time as we roll through our sectors and key insights that we're seeing in the market. So thank you. Goodbye.